Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, just retired from nearly 50 years of being in the brokerage business in BC. His website, victoradair.ca. Victor, welcome back to the show.
Well, good to be with you, Jim.
Victor, before we talk about specific markets, let's talk about the big picture. COVID's been part of our lives now for over a year. Central banks and governments launching unprecedented stimulus. I call it buying votes. Millions of people are getting vaccinated. Stock and commodity markets are soaring. Supply shortages are everywhere. And many analysts tell us that inflation is coming back. What are your thoughts on all these things happening at once?
Yeah, really, exactly. Where do we begin? I mean, I spend hours and hours a day here reading stuff on my computers, and sometimes I just kind of turn my chair around the other way and think, yeah, so what? I mean, did I learn something that I can apply? But okay, maybe just kind of tick off a couple of the high points. Massive stimulus from central banks and governments. I mean, like we've never seen before, and clearly, it's having an impact. There are always consequences, right? We hear in the United States right now, for instance, that there's over 8 million job openings that are going unfilled. Some folks are saying, well, if you didn't hand out such big pokey checks, people would take those jobs. Other folks, I should say that you're being silly or mean or racist or whatever if you say stuff like that. Clearly, all of that stimulus has had an impact on things. I mean, we're talking about trillions and trillions. In a way, also, the central banks are maybe up against a wall. I mean, the thought of lowering interest rates, you get to a point where it just loses its effectiveness. So let's say interest rates are at 0 now. If the central bank was to take interest rates to -2, is that going to jumpstart the economy if it doesn't work at 0? Now, one thing they can do, and certainly they are doing, is just continue to buy massive amounts of the paper that's issued by the governments, and then that gets us into a whole loop about modern monetary theory. But, it's had an effect. I think where the effect shows up maybe as much as, in a general way, it shows up here. People realize that the purchasing power of money, a dollar in your pocket or whatever, is going down. So people take defensive action. They buy stuff, whether it's real estate or it's stocks or baseball cards or crypto or whatever. I mean, it's like you're an idiot if you keep a big bale of dollar bills, under your desk. You want to be out of cash. So there is that effect. And, of course, that has a ripple effect. If people buy stocks and stocks go up, they buy more stocks go up some more, so people buy more stocks. So, that's what there is that. As a dear friend of mine, Martin Murenbield, and a PhD economist likes to explain, people buy stuff because stuff is going up, and that certainly is there. Another impact of that massive stimulus, I mean, last year, say, certainly as we're going through the summer, that kind of time, you had the economy was just cratering, and yet the stock market's on its way to the moon. And for a lot of folks that, like me, that might use old school, traditional valuation metrics, you say, this doesn't make any sense. Well, yes, it's a brave new world, Bucky. Get with the program. The rally, let's say from the lows of last March to where we are now, I see that in two legs. One was the bounce off the lows that happened in March until about November, which was all about stimulus, really nothing else. And then when we get to the beginning of November, we had the election, Biden is now the president, and a couple of days later, Pfizer announces they've come up with the magic syrup, and everything's going to change. So from November on, we had continuing stimulus, but we also had, a whole new regime of government stimulus, and we had we're going to get out of jail free card with the vaccines. So that's really kind of got us to where we are now. We could go on and on about this. But just in terms of what is important to markets, I think the COVID got us into a panic. We got into a hole. So the government and the central bank stepped up big time, which they should have. That's the job. I think the real question that I look at, and a lot of other folks are looking at now, is, and Stanley Druckenmiller was out with this yesterday in the Wall Street Journal and CNBC. Okay, the Fed is continuing with a level of stimulus as though we are still pinned to the floor. Is this appropriate? When's it going to end? The Fed keeps saying we are not going to ease off, until we see the whites of their eyes. I think their expression is they want to see full and inclusive employment. The Federal Reserve now is looking at social inequality and climate change as part of their mandate, it seems. We really are in a brave new world. So maybe that's all I have to say about that. Let's talk about specific markets.
Interest rates have been rising this year. The yield on the U.S. 10-year Treasury has nearly doubled from where it was last November. What's driving the change, and do you think interest rates will keep going up?
I think part of what I just mentioned there, where the market is kind of questioning, hey, what's going on with the Fed? Things have changed. See, we're not in quite the bad shape we were last March. Now, interest rates did get, I think the very, very, very low was in August of last year, when we had the lowest interest rates we've had. This is nominal rates as opposed to real rates that we've had, for thousands of years or something. Since then, I think the market started to realize that if it wasn't for the Fed buying billions, tens of billions of dollars every week of Treasury issuance, that interest rates would be a lot higher. Before the interest rates would have to go up before the market would clear. And not only would interest rates have to go up, but credit spreads would widen. And of course, then there's the argument about, well, we can't afford to have interest rates go up because the debt service would be too high. There's another side of this, and that is, with interest rates so low, a lot of people are getting killed. Think of insurance companies, pension plans, that have big commitments in the fixed income market to meet their liabilities, and, with bonds at real low levels, that's just not working. What I've said a number of times is that individuals who should be savers have had to become traders, or at least they think they have had to become traders, as they reach for yield. You're getting 0.5% maybe on cash sitting in your bank account, and you're going backwards on that. So, some friend tells you he's bought baseball cards or crypto or whatever, breathless resources on the stock exchange, and he's making a lot of money. On the positive side for bonds is, if the stock market does a swan dive, capital will go into the bond market, almost like where else can it go? So there's also, I can see from my trading perspective, a large speculative short position in the bond market, and if bonds were to rally, those folks would have to cover their positions. I guess really the way I'm viewing it is, we hit this all-time low in the bond market, or I'm talking yields, pardon me, the all-time low last August. Bonds have rallied since then. Yields have rallied since then. We had a bounce in April. I'm thinking of that as a dead cat bounce. And, this ties into currencies as well. Like the U.S. dollar was getting bid higher in January, February, and March. And as U.S. interest rates were going higher that period of time, the U.S. dollar was weaker in April as U.S. interest rates were coming off. So the markets are tied together that way. But another focus Jimmy, is on real rates. In other words, like right now, the real rate on a U.S. 5-year Treasury is about negative 1.9%. It's just never been that low. So, I mean, if you go out and buy a 5-year Treasury, and hold it until it becomes mature, you are going to suffer a loss of about 2% annually, which is, not going to inspire anybody to go out and buy government paper. My view here is that, I think interest rates go higher. The only caveat really would be if there is a shock to the system and people want safety, they might jump into bonds for a period of time, but I don't think there's anybody that figures this is the buy of the century and they're loading up the truck with bonds.
We'll have more with Victor Adair right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Victor Adair. Victor, last week, several of the leading North American stock markets were at all-time highs. This week, there's been a bit of a correction right across the board. You were previously skeptical of high-flying stocks. What do you think now?
I think we got to the highs because people got rewarded for buying stuff and they went out and bought more of it, and, you got more rewarded. So it was just a layup to buy stocks. There was no alternative. There was a fear of missing out and da-da-da-da. I think I have been skeptical, more than skeptical. I mean, we've seen some issues like ARC, for instance, has kind of been a bellwether, or Tesla. I think they both hit a high in February. But really the key word of the past couple of months in stocks has been rotation, where some of the leaders, the generals in the market has certainly been through it last year, has been big tech, and the bloom is off the rose there. I think some of the folks that might have or still do own those big capital intensive tech stocks may be taking some profits, selling some of their position, selling it all, going short, who knows? I mean, those stocks are off of their highs, but part of that would be a fear of government regulation. Certainly the new government, the Biden administration, seems to be more inclined to want to regulate those stocks, and the Republicans aren't going to be dead set against that unless it's just, to spoil the party. So there's some profit taking, there's this fear of government regulation, and I think as interest rates rise, the tech stocks are truly a long duration asset, so they get sold. And maybe also just be, there's the idea of rotating from growth and into value, big cap and a small cap, different things come in and out of fashion. Certainly last year, the worst performing sector was energy. Well, just guess what's been the best performing sector this year? Energy, and on it goes. Over the years, the past few years certainly, I've been watching the massive growth of passive investing. And at the root of it, passive investing says, listen, Bucky, the stock market just does nothing but go up. Yeah, it has dipped now and then, but really it's going to go up. And with interest rates at zero and so on, there's no place else to go. So every month we're going to clip a little off your paycheck and just put it into the stock market, whether stocks are up or down. Don't worry about it. It's just a fluctuation. And by the time you retire, you'll be rich. And we'll handle everything for you. So the thing that's wrong with passive investing, of course, and the other side of it, by the way, is people who go out and say, hey, this stock is better than the other stocks, so this is the stock we buy. That's called active management. I think one of the, not the only thing, but one of the things that I find scary about the massive amounts of money that have gone into passive investing is at some point those people might freak out. And then they'll freak out, at a low, and they'll become sellers. They'll phone up their broker and say, get me the hell out of this stuff. I'm losing my shirt. I can't believe it. We were going to take a vacation next year based on, how much money we made in the stock market. Now we can't do that and blah, 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 blah. At some point, that money's going to want to come out, and who's going to buy it? Just for a flavor of how hot the stock market has been. One of the sub-indices, the Dow Jones Transports, and there was a Dow Jones Transports index before they had a Dow Jones Industrial Index. So it's been around for 135 years or something. The trannies are up 145% at last week's highs from where they were March of last year, but they have been up for 14 consecutive weeks. Never before in the 135-year history of the trannies has that happened. There's all kinds of, let's say, technical ways of sizing up the rally in the stocks, but I would just say I think they're egregiously, quoting my old friend Dennis Gartman when I say that, overbought. And that's the way I've been trading them. And so I'm enjoying the break here this week, and I think this break can gather some momentum. One of the little submarines out there in the world is how many more of those Archegos stories have we got out? That was the guy that levered up, got himself $10 billion worth of stocks through his prime brokers and couldn't pay for it when he got the margin calls. How much leverage is there out there? All kinds of different ways of trying to measure that. I kind of want to think of it in terms of psychological leverage, and I think it's huge where there is a thought that nothing can go haywire. You just buy stocks and they go up. So, and another aspect of that too, before I wrap up on this, is that, the vaccines were the magic pill. Okay. We're going to put the virus behind us. We're going to go on bigger, better than ever, pent up demand, blah, blah, blah. And we're going to the moon. And by the way, the Fed's going to continue to print money. So yeah, you're golden. I think we just got way, way, way overbought, and we're overdue for a correction. We haven't corrected, 5% or more since November. So that's kind of my short and sweet on stocks.
We'll have more with Victor Adair right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Victor Adair. Victor, everywhere we look, we see references to a new commodity super cycle. In March of last year, the major commodity prices were down to 15-year lows. Since then, they've doubled, and some things like lumber are going parabolic. Are you a buyer or a seller in times like this?
I tell you what, I'll give you 2 seconds to guess. You just heard what my rant about the equities market. The commodities have been sizzling. You're right, the major indices hit a 15-year low last year. I think we began a major new bull market in commodities at the lows of last year. But the rally since last year's lows, I should say, has been the strongest rally in terms of rate of change that we've seen in over 40 years in the commodity market. So I think we're overdone here and more than overdue for a correction. But maybe we can talk later about, let's talk about it right now. So does that mean I just go out and poke lumber in the eye? Not a chance. I mean, that market is, it's on some weird kind of drug. You have no idea what the reaction is going to be. And the absolute scariest experience you ever want to have is to have a position in a thinly traded market like lumber and have it lock limit against you. You can't get out whether you're long or short. The market's up or down, and you just have no idea how much pain you're going to suffer before you finally get loose from that situation. So, I don't need to trade lumber. I just say, okay, it's like a gong show on the side of my screen. I mean, for people in the lumber business, it's real. I get it. For people buying a house, and it's another $35,000 for the wood, I get it. But I don't need to trade lumber. I want to trade stuff where I've got some idea, at least have the illusion of having some idea that I can manage the risk of the positions that I have on. The supply shortages that we have in different markets, and for instance, copper, iron ore, lumber, all at all-time highs. The supply shortages, and what happens is we have the price of something for delivery today. We call it the spot market, and then we have forward markets. That's for delivery later on. So a lot of these markets are in, the technical term is backwardation. That means the price of stuff for delivery today is way higher than if you're willing to wait 6 months and take delivery of it then. So this reflects, the immediate shortage, or the shortage of stuff that's available for immediate delivery. We've got this backwardation across a number of markets. In the commodities market, for sure, the speculators compiling into the front months, because that's where most of the liquidity is, as opposed to the back months. So that will contribute toward backwardation. We've got, a world of narratives here, and one of my favorites is copper. I get it, and by the way, I did not get into the copper market. If I'm so smart, why didn't I load up on copper at last year's lows? Well, as a trader, if you don't learn to forgive yourself for the things you miss or the mistakes you make, you're going to really have a miserable life. Copper has got this climate change narrative, and it basically is this. There is not enough copper to meet all the requirements we have for copper going forward because of the green demand, and it takes years to bring a new mine on a production, and nobody can find any new supply of copper anyway, so the price has to go to the moon. And it has. And at some level, that will get overdone. I think it's probably there already, but just like lumber, I'm not going to go short copper because I got a hunch and think I'm right. About commodities generally. Late last year, I wrote a piece, I think it's on my website, it was certainly published elsewhere, that said, in essence, we got a new bull market in commodities, and one of the things that's going to happen is that at the institutional level, where people have some version of a 60-40 portfolio split, 60% in equities, 40% in bonds, the idea being that the bonds kind of act as a ballast to the stock. Well, with bonds at zero yield or real low yields, that doesn't work anymore. So people are going to be looking for alternative investments to take the place of some of their bond investments. And the thing you're going to buy is commodities. So I think that makes sense. I think that still makes sense. And, but do you buy it here, I guess is the question. Soybeans and corn are at 9-year highs here. I'm not a buyer. And I'm not willing to be a seller either, because they could rip higher some more. I just can't see how I would manage my risk on that, but I see it. What I'd probably more likely do is say, okay, if the conditions persist where I think there really is a bull market in commodities, I want to look for some kind of a nasty correction where a lot of the people who have no idea what the hell they're doing and that are in that market get shooken out of their positions, and we find some level where the market seems to have some value, and then I'll be a buyer.
The U.S. dollar surged to nearly 18-year highs in March of last year when people panicked over COVID. As the panic subsided, the U.S. dollar trended lower for most of the year, hit 3-year lows in January. It rallied around the end of April. It's been weaker the last few weeks. Where do you think the U.S. dollar goes from here? And what about the little old Canadian buck?
Well, I'll talk U.S. dollar first and then go to the Canada. I guess one of the most important things to me, and because I'm just an ornery bugger, okay? I like to take a contrary view or a contrarian view. For the last year, or certainly since the panic in March of last year, the market has been net short of the U.S. dollar. At times, a few months ago, we were near record net short. That means speculators, some are long, some are short, but net of those positions, they were very short the U.S. dollar. And, you don't have to dig very far to find people who can give you 18 reasons why the U.S. dollar is going to go lower. And I kind of say, well, I think I want to examine the opposite side of that. If the U.S. dollar was to start to go higher here for some reason, there's going to be a lot of people that are wrong, and they would need to cover their position at some point. And some guys might want to hang on for a while and then finally capitulate, whatever. I think what we call this the pain trade. For the market right now, the pain trade, other than stocks falling like crazy, would be for the U.S. dollar to start to rise. And I just kind of think that might happen, and certainly, as we saw in March of last year, people that think the U.S. dollar is useless certainly love it when there's a panic and they want to flood into it. And then there's the other side of the trade. If you're buying the U.S., if you're selling the U.S. dollar, what are you buying? You want to switch out of U.S. dollars and go into Chinese RMB or the euro or the Japanese yen? Well, maybe, certainly for a good chunk of last year, if you'd done any of those things, you would have been money ahead. I'm just, as I say, predisposed to be a bit ornery, contrarian. I think the U.S. dollar might just surprise here to the upside. That's my view. And part of it is the overall bullish enthusiasm that has been manifest by stocks only go up, commodities are in the new super cycle, you got to buy them. Sort of the same part of that thinking is, who needs the U.S. dollar? Dump the U.S. dollar, buy some exotic currency somewhere because it's off the radar. I think the bullish enthusiasm here is obviously I think it's run too far, and so that may also manifest in the currency markets by the U.S. dollar rising. The Canadian dollar has been the strongest currency in the world. I can look around maybe and find some obscure currency somewhere that's been stronger, but really from the major traded currencies, Canada's been the big dog here for the past few months anyway, certainly all of this year, maybe in a part of last year. The reason, it's a commodity play. On my website, a few times I put up some charts where I show the correlation between the Canadian dollar and the different commodity indices or the major commodity indices on a number of different time frames. And, I think the rest of the world buys the Canadian dollar as a play on the commodity market. So when commodities are hot, like they've been, the layup trade is you just buy Canada. The Canada's also been rising because stocks have been rising. There's been a very strong correlation, again, on any time frame you want to look at, from 5 minutes to 5 weeks, correlation between Canada and the S&P 500. It's a manifestation of the pro-risk trade, just as a weak U.S. dollar is a manifestation of the pro-risk trade. There's a small interest rate advantage to Canada. I really don't know how much that matters. But lately, the big thing was the Bank of Canada. Their last meeting, it was a Thursday late last month, they kind of shocked the market when they said, we're going to be less dovish going forward than we have been. And that was manifest in they're going to scale back their weekly bond purchases, and they were moving forward the date when they might bump up interest rates. Well, by comparison with the Fed, the Bank of Canada will look like a full war eagle coming at you. So Canadian dollar was just a tad above 79 cents that morning. I was short the Canadian dollar, thinking, okay, here we go. And Bank of Canada did what they did, and the Canadian dollar has risen to just about 83 cents this morning. I haven't stayed short, believe me, all that period of time, although I'm back on the short side of Canada. I just think this thing is, to use that egregious word again, Canada's way overdone at the upside, at least for my time frames. I wonder if there's not some magic magnet that is drawing that Canadian dollar to the level of 1.20. That's how a lot of the commercial world trades the Canadian dollar. We talk about it in terms of 83 cents. 83.3. The reciprocal is 120, and maybe the market's being drawn to that level. Just to wrap up then on Canada, we have the largest net long speculative position in the futures markets that we've had in well over a year. And the foreign exchange world is, from my perspective, absolutely ignoring the lockdowns that we have across this country, which are hurting our economy, they are seeing Canada as a commodity play. And it's also been a strongly trending market. We're up, I'm going to call it 22% from last year's lows, and it's been a nice, in a way, plodding uptrend. So the computer trend following systems are all over the Canada like a dirty shirt. The open interest in the futures market is really high compared to where it's been for years. So it's got all the earmarks of it's got a lot of people in there on the long side. They've been rewarded for being in that position. And if the Canadian dollar starts to go the other way, they'll probably have to bail out, and people like me who are on the short side will be happy.
Gold is up about $175 from its March lows, but still about $200 below the highs it made it last year. With all this concern over inflation, why isn't gold higher?
Yeah, that's a real good question. A lot of people that are gold bulls have been, I think, puzzled about that. But let's kind of go back to something we talked about last year, and that was the gold ETF market. On this series of interviews that we've done many times, I made the point that the ETF market was huge in terms of the impact that it was having on the gold sector. The gold, would be essentially North American and Europe, but let's call it's a global measure, but if you take the United States and Europe out of it, it doesn't matter. They were huge buyers of gold March, April, May, June, July of last year. And then the market made its high in August. From November until April, those same folks that were buying have been sellers. Now, there's still a huge position, net long gold in the ETF market, but those swings at the margin, I think, have made a huge difference. Say it another way. People like to buy stuff that's going up. Gold was not going up. Other things were going up. So, people would buy ARC Resources, but not ARC Resources, but, buy into that ARC ETF instead of buying gold. Bitcoin and the other cryptocurrencies definitely hurt the gold market. I mean, folks like you and I, Jimmy, of a certain age, we remember, it's indelibly seared in my mind, the gold rally in 79 and 80, when we basically ran from, let's see, if we go back maybe to 77, 76, but we ran from $100 to $850, which was a huge move at that time. But the millennials and Generation X's and, the younger folks don't have that memory of gold. They're much more enamored with the crypto market, and so it's the seniors that would be interested in the gold market on that basis, and so that has taken some buying that might otherwise have gone into gold has gone into the cryptocurrencies. In terms of shorter term here, the gold market made its high for this year in the very first week of January when the U.S. dollar made its low for the year. And then you flip it around the other way, gold turned up at the end of March, which was exactly the high year-to-date for the U.S. dollar. So the gold market has been the other side, or the mirror image, as it were, of the U.S. dollar market this year, and I think that's likely to continue. I mean, historically, for years, there's been a very high negative correlation between gold and the U.S. dollar. Why isn't it going higher? Well, it has started to turn higher, up $175. I mean, it's been smoked by, if you compare it to lumber or soybeans or copper, that sort of thing, but or Bitcoin. As much as I like the U.S. dollar, and I've just made the case that, gold is usually the mirror image of the U.S. dollar, I could see a time if the markets get a little nervous or scared where gold and the U.S. dollar both go up together. I don't have a position on in gold right now, and I'd tell you if I did, but so, I could go either way, but right now I'm probably more inclined to want to be a U.S. dollar buyer, or, the way I'm doing that is selling the Canadian dollar.
Over the past few years, we've wrapped up our interviews with you talking about some of your trading rules or principles. What have you got for us today?
Okay, I two thoughts. One is I say a lot that it's really important to keep the time frame of your trading in sync with the time frame of your analysis. And I believe that's really, really true. And, if I'm looking at a short-term chart and I get into a position based on that, and the position goes against me, and then I say, well, let me see, I'm just going to change my analysis here by looking at a longer-term chart, which would justify staying with that losing position. Like, just don't do that. But I thought about it, and this is, I lost money last month. I'd say about 1.5% of my trading capital, so it's not like I, am in the poorhouse or anything. But I really do believe you learn more from losing money than making money because you get reflective. Say, well, what the hell happened? What was I thinking? What did I do wrong? How did I get, all that sort of thing. And part of that was I had purposely, I guess around the end of March, decided I wanted to try to lengthen my time frame. So I took some positions with the idea that I would sort of stay with them through hell or high water for a longer period of time. So that meant certainly I took smaller positions, or I kind of capped the risk on them, like, say, using some option strategies or whatever. But what ended up happening is I sat with losing positions for 3 or 4 weeks. That was no fun because I had this idea that I wanted to lengthen my time frame. So ideally for me, I know that my ideal short-term time frame is about a few days to a few weeks. And if I venture from that, like, I have no interest in trying to go and clip the market, in a matter of minutes. I'm going to jump in and jump with the intention, jump in and jump out, in 2 minutes or something, or 2 seconds. I mean, I just can't do that. I don't have I have no edge there. But if I'm dealing, a few days to especially a few weeks, I think all of that short-term noise can kind of fade away a little bit, and I've got an edge. Another aspect that goes with time frame is what I would say is how much can you afford to lose. Anytime I got an idea. Let's say it's market X, and I think, I've done my research, and I think market X is probably a buy, so I'm looking for what I would call a setup on the charts as to where I'm going to buy it. For instance, I don't do my research and say, gee whiz, I think X is a buy. Okay, enter a buy order at the market. Don't even look where it is. No, I just couldn't do that. I want to look to see where I can get into the market at what I would call a good level. And so the side of that is, if I buy it here, where am I wrong? Okay, and I have to know that. If I buy it here and I'm wrong at that level, I go, let's see. If I trade normal size, that's more than I want to risk, so therefore I either have to reduce my size or don't make the trade. Wait for an opportunity to put the trade on when the amount that I'm going to risk is worthwhile. I remember a trader friend of mine years ago said he wanted to enter a trade in a market as close to the point where he'd be stopped out as possible, so that if he was wrong, he only lost a tiny bit of money, but if he was right, he won a huge multiple of what he was willing to lose. So those two things kind of go together. The affordability, or how much you're willing to risk on a trade, I think in many ways, dictates what your time frame can be, and certainly dictates what kind of size you use. So the net on that, Jimmy, it's the old line of there's nothing wrong with being wrong except staying wrong, and trying to get yourself into trading where you have winning positions. You understand you're going to lose money. It's just a cost of doing business. Just keep the losses small. Know what they're going to be, so that when you have a trade and it goes one way or the other, it's no big emotional moment. It's just a trade.
Victor, thank you so much for chatting with us.
Good to talk to you.
My guest has been Victor Adair. He just retired from nearly 50 years in the brokerage business in BC. Visit his website at victoradair.ca. If you have any questions for Victor or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of How Street Media Incorporated.